So, over the past few days, we've been asked one question more than any other. Could the conflict involving Iran actually cause the Dubai property market to crash? And if you're currently invested in Dubai property, particularly in the middle of an off plan purchase, that question suddenly feels very, very important. Because when geopolitical tensions rise, it's natural to imagine worst case scenarios. But serious investors don't rely on headlines, they rely on history, data, and how capital actually moves during uncertainty. So today, we're going to look at what the evidence actually tells us. Property markets rarely collapse because of a single event. Historically, major crashes tend to occur when three pressures happen all at the same time: excessive leverage, oversupply, and liquidity disappearing. When highly indebted owners are forced to sell and buyers disappear, prices can fall very, very quickly. We saw this happen during the 2008 global financial crisis, but geopolitical shock alone really creates that combination. If we zoom in and look at Dubai's property market over the past 15 years, something interesting appears. The market has already navigated multiple global shocks: the 2008 global financial crisis, the Arab Spring in 2011, the COVID pandemic, and the Russian-Ukrainian war, which started in 2022. Yet, despite those events, Dubai's real estate market has continued to evolve and attract international capital, which tells us something important. Major geopolitical events do not automatically cause property markets to collapse. What matters is how investors and capital respond to it. To understand this, it helps to look at the Arab Spring. Beginning in 2011, several countries across the Middle East and North Africa experienced a political uprising and instability. Countries like Egypt, Libya, and Syria saw major economic disruption. During that time, many investors and business owners moved their wealth into more stable jurisdictions. And one of the cities that benefited from that movement of capital was Dubai. This highlights an important pattern in global markets. When instability rises in one region, capital rarely disappears. It moves towards stability. Investors look for places with political stability, strong legal systems, international banking access, and open property markets. Dubai has spent the last 2 decades building exactly that environment, which means that during periods of uncertainty, the city can often become a destination for capital rather than a casualty of it. We saw another example of this during the Russia-Ukrainian war, 2022. Sanctions and banking restrictions forced many wealthy individuals to move assets internationally. Dubai very quickly became one of the primary destinations. Luxury property transactions surged, and the city recorded some of the largest real estate deals in its history. Once again, global instability redirected capital towards a stable hub. This trend is also supported by global wealth migration data. Recent international reports show that the United Arab Emirates has become the world leading destination for incoming millionaires. Thousands of high net worth individuals relocate to the UAE every single year. And when wealth moves, property demand often follows. Dubai's property market entered this period of geopolitical tension from a position of strength. Before the recent conflict with Iran began, The market had already delivered a record-breaking year. 2025 alone, Dubai recorded 970 billion in retail transactions, the highest in its history. There were more than 270,000 property transactions, including over 200,000 residential sales. These numbers indicate a market that is active, liquid, expanding, not frozen. The market is still transacting. One of the clearest signals of a property market under stress is when transactions suddenly stop. Buyers disappear, banks stop lending, deals stop completing. But when we look at the latest data coming out of Dubai, we see something a little bit different. According to the Dubai Land Department transaction dashboard, the market continues to transact at scale. In just the last few days, the system has recorded well over 1,300 property sales in Dubai. That's the last 5 days alone. That tells us something important. Buyers are still active, deals are still completing, and liquidity in the market has not disappeared. Another important signal investors watch closely is mortgage activity. Because when property markets are about to crunch, lending usually disappears very quickly beforehand. But mortgage transactions are also recorded through the Dubai Land Department registrations. And those records show that mortgage-backed transactions are still taking place. Which means banks have not suddenly withdrawn lending from the market. If lending had frozen, we would see that immediately in the transaction data. And right now, this hasn't happened. So, what does all of this mean if you're currently investing in Dubai property, especially off plan? The most important thing is not to react to the loudest headline. It is to step back and ask more practical questions. Has anything fundamentally changed about the reason investors buy property in Dubai? Is the city still attracting global business? Is international capital still moving here? Because if those long-term drivers remain intact, short-term uncertainty really defies the outcome of multi-year property investments. Moments like this are when markets often feel the most uncertain, but uncertainty is also when disciplined investors rely most heavily on evidence rather than emotion. Because in property markets, the difference between reacting to fear and understanding the data is often what separates short-term noise from long-term strategy. And that distinction is where informed investors tend to make the best decisions.